I'm 92.90, 10 by 10. Yours.
Mine.
99 at the buck. Welcome to the OpenYield Markets Podcast with your host, Mark Hebert.
So I'd like to welcome everybody to the first of many OpenYield's monthly Markets with Mark podcast, where we're going to explore groundbreaking shifts in fixed income, both in markets, market structure, technology, and automation. So I couldn't be happier to get this podcast going, and I am very pleased to introduce our first two guests to the OpenYield Markets with Mark podcast. That is Marty Mannion and Matthew Schrager, co-heads of TD Automated Securities. They are basically the Lewis and Clark of automated trading in the fixed income markets, pioneers in their own ilk. Marty is started out at Citadel, where he was I believe, chief operating officer before going to Headlands Securities, which is where the automated securities trading started in fixed income. And Matt was at DRW, a prop firm, before joining before joining Headlands and now TD. So TD Automated Securities acquired Headlands, and now Matthew and Marty, or Matt, I should say, are running this business both in munis, and now they've assumed credit. And most recently, they've actually taken over the voice business as well as automated trading at TD. So there will be some questions about the integration. So I want to kick it over to you guys. That was a brief intro, but if you want to tell me a little bit more about, how TD found you, what was different about your process or special that you guys were building at Headlands that made you guys, on the map, if you will, as pioneers?
Yeah, for sure. So, Mark, thanks so much for having us. Really excited to be on the podcast today. We'll give a bit of the origin story, which I think will help, kind of explain why we think what we've built here is quite unique. So, we started our fixed income journey in a very maybe non-obvious place, which is the municipal bond market. Neither Matt or I were fixed income people by background. For those who don't know, when we started our business, it was at a firm called Headlands. Headlands is a market-leading quantitative trading firm that focuses more on low latency style markets. And the three founders of Headlands had a very long and distinguished track record building electronic trading businesses across a number of asset classes. This included really starting from close to scratch the equity and options business at Citadel Securities, which today are the dominant businesses in those two categories, and really formed at the time the very foundational pieces of that Citadel Securities franchise. They also, one of the founders was very involved in building Island ECN, which was an early innovator in the equity markets. So around 2013 or so, the founders believed that there was a real opportunity to build a unique business in fixed income, starting with the municipal bond market. And the theory was, the market is fairly inefficient. There's very little automation, but through a combination of kind of regulatory and technical forces, we were at the cusp of seeing automation really take hold in that space. And we really felt like there was an opportunity to get in early to build a business that could provide, a real scalable solution to liquidity provision, especially for retail investors, so that we could come into the market, provide something of real value to end investors in the municipal bond market. And if we were successful in doing so, we could scale that out across other parts of fixed income, including the investment grade corporate bond market. And as we'll talk about today, hopefully in the future, some other parts of fixed income that we think are ripe for automation.
Now, Marty, if you don't mind, just because, as many of the listeners that we're going to have will understand these products and markets astutely, just you want to expand a little bit about what latency is and how you can use it to your own benefit.
Sure.
For the market's benefit.
Yeah, absolutely. So when we talk about latency, we're really referring to the speed of execution. And so if you look at an asset class like, let's say, futures or equities, you tend to have a small number of tradable instruments. You have liquidity or activity concentrated on centralized venues, and you have orders executing in many cases, sub-seconds, sub-milliseconds, sub-microseconds, right? So if you're going to compete in those markets, you have to build a highly technically performant system that relies on the ability to execute orders in an extremely tight kind of time frame or window. When you look at something like the fixed income markets, they're really the inverse of what I've described in, say, equities. You have hundreds of thousands, or in the case of munis, millions of tradable instruments. You have a kind of a fragmented market structure where activity is happening across a variety of venues or direct relationships with clients. And then you have liquidity, kind of scattered across all of those different channels. So really, speed is much less important in that market, but automation is still critical. So you tend to have, thousands of orders or executions as opposed to millions of executions. And so when we think about the world, we think of markets on a continuum, where you have these very latency sensitive markets, and then markets like fixed income, where latency doesn't matter as much, but some sort of automation and pricing and being able to deliver electronic liquidity to clients is really important. And what we've seen historically is that automation typically takes hold first in markets that are very latency sensitive. And so that's why I think you've seen over time the adoption of electronic trading in, like, say, the futures or equity markets happening much more quickly than maybe the uptake in fixed income.
Yeah, that kind of brings me to the first question I really had is, and I'm an IG credit guy. So for me, in my lens of looking at fixed income as a whole and always understanding the products, munis has always been, one step down the liquidity profile from IG credit, right? And and when I say liquidity, I mean the ability to trade a CUSIP on a daily basis in munis is so much different because the size of issuances are so much smaller in general, with a lot more CUSIPs. And just the traditional buyer base is a little bit different and sticky to what they're buying. And so it kind of brings me to this conversation of, how do you guys see or have seen automation really take hold in fixed income, right? So for a long time, as we were growing up, equities, futures, options, were all that was, talked about and traded in milliseconds, as you mentioned. And now we're on the forefront of something where, voice trading is still a big prevalent part of our markets. But if you look at the ticket sizes and ticket counts, the ticket counts are going up and the ticket sizes are coming down because you have other participants into the marketplace, which is really allowing for automation and electronification to have its airtime, if you will. So I guess my question to you is, how have you guys been able to proceed with automating fixed income? And how have you been able to talk to customers to get the buy-in, if you will, to understand the new paradigm that fixed income is kind of taking hold vis-a-vis other asset classes?
Great question, Mark. So, I think when you talk about automation in fixed income and why it's taken longer, I think and what kind of led to it eventually actually happening, I think, it was mostly inevitable. I think it was mostly a matter of time and the technology kind of getting there, but it definitely has taken longer. There's no question about that. And there's a lot of reasons why that's true. Bonds are more complicated than equities. There's more, the technical term would be features, but there's more stuff about them that matters, like the coupon and the maturity. These things don't exist for equities, right? There's way more of them, as you mentioned. In equities, there's like a few thousand equities that matter. In munis, let's say, there's 1.5 million CUSIPs, right? Each one of them is way less liquid. And all these things were frictions to getting towards more automation. I think there were regulatory factors at play as well. It's easy to forget now, but there was a time where there was no trade reporting, right? There was no trace feed. And the only people that knew where bonds traded were the dealers that traded them, which makes it very, very difficult to automate. There was no best execution rule. until, just less than a decade ago. So these things are relatively recent, and I think there's also just a bunch of human inertia factors, right? Like people just used to doing things the way that they've done them, and so it's definitely taken longer. But a phrase that you will hear a lot if you're around us enough. Marty's going to kill me because I'd say this all the time, but is that markets tend towards efficiency and tend towards transparency. And you've seen this in market after market over time. And automation is just a huge part of how they get there. And why do they get there? Why do they go towards efficiency and transparency? Ultimately, it's because it is simply just a better and more efficient result for the constituents that the market should serve. And the way that we think about that is, well, who should the market serve? Right? First of all, I think the most important part of the answer to that question is not us. We don't matter. We're just intermediaries. We're liquidity providers. We should benefit to the extent that we produce a better outcome for the people that the market should serve, who are the end customers, right? Retail and institutional buy side on one side, and then you could say issuers on the other side, but that's more of the primary market, right? And automation is what helps the market serve those constituents the best, right? Like asset managers through automation can serve their clients more cheaply. Dealers can respond to client flow more cheaply. Ultimately, this all just leads to a significant reduction in cost, right? Frictional costs throughout the system. And you see this everywhere you look. You see management fees going in a race to zero. You see bid-ask spreads and transaction costs also in a race towards zero. And you get that because the marginal cost in the presence of automation, the marginal cost of an extra trade or an extra dollar of AUM, let's say, collapses towards zero, right? And in a competitive market, you're going to gravitate towards the thing that reduces the marginal cost towards zero. And technology is a big part of what makes that happen, which is why I've seen it catch on.
So I guess interesting point. You guys have been doing this a long time, right? And as I mentioned earlier, at the forefront of automated securities in fixed income. Was there a fulcrum point for you on the bell curve where you said, wow, Marty, this is going to work? Or as you guys were working together early stages, you just mentioned all these things about efficient markets and how things tend to trend towards efficiencies. Was there a point in this process where you said, okay, the fulcrum point has been reached? What was that? And when did it occur? And why do you think it started to really occur? I guess you maybe even answered that, but what was the fulcrum point or the point of the bell curve where you said, we have a real runway here?
I look, I can answer for my part, and Marty, I'm sure you'll have. I can say emphatically, there was never a fulcrum point where you're like, oh, we've suddenly arrived, right? It's just like any, building any great thing in the world, any great business, any great product, whatever. It's just a grind. It's a constant grind, and it never feels like you've actually, at least in my experience, it never feels like you've had the epiphany, right? So it's a matter of talking to clients endlessly for years and trying to explain, why there's benefits to this way of interacting with the market. It's a matter of talking to candidates and recruiting them into this business from other asset classes where they might have never even thought of. Why would I ever join fixed income? That's not automated. Well, it's moving in that direction, right? And you see a slow and steady increase over time. I think if you had to point to one moment, I think getting acquired by TD was kind of a pivotal moment in our history, and we could talk about that more. But no, I think it's been a slow, consistent burn. And more to the point, we might talk about this more later. I don't think we're anywhere near the finish line. I think we got a long way to go from here.
Real quickly on that, yeah. Go ahead, Marty.
Mark, maybe I would just echo Matt's comments. We often say, building these kind of businesses from scratch, you're like living in a glass case of emotion at all times, and that's certainly been true of us. I'll say one kind of additional comment, and that is, this is less, everything Matt said about building the business is spot on. I would say that we didn't really touch on this earlier, but the kind of the triggering event for getting into the market was actually changes in regulation. And so believe it or not, it was, and this was, credit to the Headlands founders, back in, 2010, 11, 12, I think they really felt like there was a business here, but the challenge was how do you actually get involved from a liquidity provision standpoint as a non-traditional dealer? And the SEC in 2012 put out a big market structure report talking about, maybe we should take some of the rules that existed in equities and apply them in some way to fixed income. And that would include very simple things, a best execution rule, an order handling rule, better disclosures and transparency around trading. And that for them was really the triggering event to say, okay, there's an opportunity here. Let's go build the business. But as Matt said, when you do this, you pivot, every 6 months to a year, you're constantly refactoring and re-architecting what you've built. And so you kind of feel like you're always on that treadmill and always on that journey to build it the right way.
Just a constant stream of emotion. I like that. The glass case of emotions.
I will say, Mark, it's definitely, if you think back, 5, 6, 7, 10 years ago, there was a time where if you went to like a fixed income conference and you wanted to talk about automation, you felt like a pariah. Nobody wanted anything to do with you. And I think that tide has emphatically turned now, and you go to a fixed income conference and almost the only thing people talk about is automation.
80% of the panels now are on automation. So,
exactly.
it has changed. I actually remember from my credit days, I used to trade voice only. And then in 2012, we get this pop up with an FA buying something for his high net worth. And then in 2016, I would get 20 pop ups. And by 2019, I was trading honestly between 5 and 40 million a day just through the channels. And I was like, okay, this is changing. Which brings me kind of to, the next point of conversation is, fixed income traditionally has been a 60-40, let your FA handle it. I honestly at the middle class and up level, and you didn't really have any hand holding or real touch from retail. And now, you can point to interest rates, you can point to automation, but, when you go onto your brokerage account, 7 years ago, buying a bond was extremely onerous, right? And I'm not saying it's less onerous now, but it's definitely gotten better. Can you guys speak to a little bit about how you've worked in the ecosystem of, as you mentioned earlier, the friction and the costs of friction have come down, but it's really allowed for retail to join this market like they never have before. Not to mention interest rates have gone up for the first time in 40 years. And when I say up, it's extremely marginal. But I mean, we have had a rise in interest rates for a year plus time for the first time really in a long time. Could you speak a little bit about how you view the retail customer now, how you engage them? And then if you wouldn't mind, also, you mentioned the fulcrum point might have been being acquired by TD. Could you mention a little bit about the difference in operation with the balance sheet you have as a bank business now versus before, and maybe tie it all together with retail?
To tie it all up in a bow, there's sort of two separate questions.
But within the glass, I want it to be within the glass cage of emotions, if possible.
Everything, Mark, is within the glass cage of emotions. I like, by the way, how a 500 basis point increase is air quoted.
Yeah,
I think that counts as a real increase in rates, definitely higher. All right, so in terms of retail and sort of what has prompted retail or enabled retail to engage more meaningfully in the space, I think it's like anything, it's a combination of a lot of different factors. Look, certainly the rate environment doesn't hurt. It is, I don't think this is going to be a surprise to hear for anybody, it is not easy to get people interested in bonds when they yield 25 basis points. Just not that interesting, right?
It's a tough cookie to give away.
It's a tough thing to sell. Like the sell this pen kind of thing. It's easier to sell a pen than a bond yielding 25 basis points. But look, so that's part of the story. But I think that is only part. And I think a lot of the themes that we've been discussing are sort of preconditions for retail even engaging in any sort of meaningful way at all. I think if you really think through it, a meaningful retail presence is only feasible or possible when you have a lot of automation. Because if you think about, if you think about the composition of retail flow, right? It's just tons and tons of tiny little trades, right? And from the perspective of a dealer, it's just impossible to service that kind of flow if you don't have a lot. If a person has to respond to every single retail trade and you have millions of them, tens of thousands, hundreds of millions of them every day, it's not possible. So you almost require an algorithmic liquidity provider to even contemplate the existence of significant retail flow. And so we've seen a lot of that, and you get the retail flow on the back of it. I think there's also an element, how do I put this? Let's say of going to where retail is, right? And what do I mean by that? So if bonds only ever trade over Bloomberg chat, that requires a $20,000 a year subscription.
I think you're a little low there, but yes. Yeah.
Whatever. Yeah. Maybe multiples low. Right? You're not going to get a lot of retail there. If it requires calling up a dealer who you're never going to, you're never going to get retail involvement that way. But if they can, pull up an app on their phone and buy a bond while they're picking up their latte or whatever, now you're talking. That gives a real entry point, right? And to be clear, I think we are in the very early innings of that happening. Like if you think about my mother as an example, who is not a financial person at all, right? And she more or less knows what a stock is, to some degree of precision. But if you ask like an average a normal person, let's say, what a bond is, most of them, let's just face it, don't have any idea, right? And so I think we have a bit of almost call it a PR challenge, right? We need to figure out how to how to present bonds in a way that is digestible. I think that's going to come from, retail focused distribution outlets that make bonds that can make bonds more friendly. But in order to do that, there's a lot of infrastructure and piping that needs to exist that like just hasn't historically existed. Think about an app like just to make one up, like a Robinhood. I would bet, with no inside information here whatsoever, I would bet that 3 years ago, Robinhood like didn't even have the concept of a bond in their code base anywhere, right? And but by contrast, on the flip side, if you're able to quote unquote get bonds on the front page of Robinhood, or there's lots of other apps you could talk about here.
Yeah.
If we could really make it that easy, right, which I think we can, then I think you'll start seeing a whole other level of retail engagement. And to be clear, I think that this is starting to happen. Firms like, call it a Fidelity or a Schwab, have really made a lot of progress on it has become a lot easier to interact with fixed income through those platforms, and we see it in the flows. There's a number of other firms working in this direction too. Of course, OpenYield is one of those firms, but I think we're very much in the early innings here.
Yeah, I mean, if you think about it, the consumer took X amount of years to get educated about stocks to a degree, and my personal opinion, and during COVID, what happened was people were home and took time to start really looking at the stock market more actively, or a larger percentage. And if you think about what's happening in fixed income, the education of the consumer, to your point, is in the early innings. So, and it is getting easier on these, brokerage firms and apps. But I would also agree with you that, a Robinhood or some of these new age brokerage firms, a bond was not on their roadmap years ago, and I think that's changed now. And it might come to a point down the road where you log on to your, app or your brokerage firm, whatever it may be, Fidelity, Schwab, Robinhood, Webull, etc., and your screen will show all your equities. And let's just say there's headlines about a company that day, or a municipality, or agencies, or whatever the headline is, and your screen will now show two things. It'll show the stock down 25%, and it'll show liquidity in a bond down 7 points. And that will give the retail investor an option to say, hey, bonds aren't 5% yield to maturity anymore. This is something I can also trade. So I think, to your point, the early innings is where we are, and it's the education of the consumer. And you do things like podcasts, and you send them to everybody, and you try to educate people that the asset classes around equities are as robust and more so in our case. And retail engagement should be here to stay. So I totally agree with you there.
You know what you could do, Mark, that would really help? It's timely too. You could take out a Super Bowl ad.
Yeah.
For OpenYield.
We're a startup, so I'll talk to
you. Just raised a round, no?
Yeah, we did. But I'll talk to the powers that be, and we might be in the puppy bowl though. I heard those ads a little cheaper, but hey, by the way, people watch that stuff, so don't get me wrong. I don't, but people do.
Mark, just one quick point. I think it's a really good one about the kind of the education point that you made. I remember back to the very first conference that we went to when we were starting this business in fixed income. We used to go to all these things in equities and options and what have you. And we were sitting with someone who had basically built one of the big options platforms at one of the retail brokers. And I think on one of the panels, they were talking about how, direct retail is a real challenge in fixed income because the product is very complicated and retail won't understand it. And, the individual I was sitting with was like, well, think about an option and how, complicated an option is. But if you look at the US options market, it's almost entirely a retail driven market.
Right.
And a lot of the reason, there was such an uptick and such an adoption is you had something similar in options. You had a lot of price transparency that was driven by electronic trading, competition amongst the various exchanges, and a tremendous amount of education that was done by the retail brokers that really helped foster that market. And I think to your point, we're seeing something similar in fixed income. And what's interesting is it's not just in the pure direct retail channel. We talk a lot about, professional retail, particularly in something like the separately managed account channel. And that's an area where you've had, explosive growth. I think depending on what numbers you're looking at, that channel is big, or if not bigger than, the traditional mutual fund channel in a market like, municipal bonds, and it's been kind of, just up and to the right, the last, 10 years or so. And some of that is, again, this bringing together of, a better ecosystem for trading, more automation, the themes Matt talked about earlier with, spread compression, all of that just kind of fosters this, greater activity. And there's also I know we'll maybe talk about this later, the tie-in with ETFs, where you have yet another, understandable and tradable instrument for retail that's very efficient and effective.
Yeah, I guess that's actually where I was heading next. Anyways, is we'll talk a little bit about secondary trading, and I want to touch on primary market trading a little bit later, but I want to go to secondaries next. And you guys have just assumed the voice desk as well as the automated desk at TD. And your ecosystem now is ETFs, retail trading, automated trading, voice trading. How do you guys handle all these products on a daily basis in terms of operation, scale, and opportunity? So, what's the process look like when there are so many avenues now to trade fixed income?
I'll kick it off, and I know Matt will want to jump in here as well. So we, being a part of a bank like TD, one of the real exciting, opportunities for us was going to a place, with balance sheet, with these established, institutional style businesses in, the credit market as an example. So TD had a great business there. We were, as you mentioned, building out separately a fully automated algorithmic business. And I think what you've seen across the street, not just at TD, but really at all the dealers, is that really where the market's headed, you have to be able to marry those two, channels together. And so that doesn't necessarily mean that, every order is going to get executed in a fully automated fashion. Quite the opposite. What it does mean is that technology, workflow improvements, better data and analytics that you need to deliver to the voice traders is a critical part of competing in this kind of new ecosystem. And so what we're really excited about is leveraging or extending, some of the processes and the pricing and the modeling and analytics that we've built, and pushing that into the voice channels, and being able to trade, these products, or these types of flows, side by side with one another. And if you think about, as an example, you touched on, say, ETFs. Well, in ETFs, as Matt likes to say, it's a basket of bonds, right? And so, you're trading the ETF off of the underlying cash bonds. And then if you're trading, a portfolio trade, which has become much more prominent in the market, that is similarly a big basket of bonds. And so that portfolio trade could be priced by the algo. It could be priced by a voice trader. It's typically going to be some mix of the two. And, if you're pricing that for a client, they want a response back in, 5 minutes, right? So you're pricing all this risk across hundreds of different instruments, different sectors, different maturities, different credit ratings, et cetera. That sort of automation, again, even if it's ultimately a very talented voice trader who's making the ultimate decision on that risk, they have to have better tooling to be able to compete for those orders in a highly competitive market. So really, we view that there being a tremendous amount of synergies to bring those various pieces together.
Yeah. Matt, you want to add to that?
I think Marty covered it pretty well. I guess the way that I would think about it is, clients, be they institutional or retail, want to trade credit exposure in a bunch of different ways, right? And we, as a dealer, if we want to be a top tier dealer, which we absolutely do, then we need to be able to service that flow in all of the formats that they want and need it, right? So whether that is a one lot trade, $1,000 on a retail platform in RFQ format, or $1 billion portfolio trade, or trading ETFs on exchange, right? They're all ultimately the same exact type of risk, right? And our job as a dealer is to intermediate between all those different clients who want to trade that risk in all different forms, right? And so we fully intend to have a full service offering across all of those channels.
And then, speaking, you just mentioned the RFQ process a few times. What do you guys think as we evolve and automate? RFQs, in my opinion, are somewhat, becoming old fashioned in a sense where, if I'm a client, I'm going to give a host of dealers 20 minutes to price up a list of, let's just say, 10 or 15 securities. With the rise of algorithmic trading, and I would say, to your point, the synergies between a voice desk and an algo desk, the ability to price risk more quickly and what I would say less emotionally is there. Do you guys see the RFQ process changing? Do you see it going away to more click to trade, live liquidity? I remember as a voice trader, I was told my traders that worked for me, don't gripe over saying done. Your market was your market. But there's a lot of guys who trade who would, let's just say, not trade or fade on the market.
Back away.
Back away is a great word for it. Yeah. And then they would call the salesperson, though, 20 minutes later and say, hey, call that person back. I can actually get to that level. And had that kind of trader's remorse. And I feel like the proliferation of algos has kind of taken away a little bit of that emotion and just said, hey, this is the price. This is what our model is telling us to do. And in my estimation, that probably makes RFQs or old school RFQs need to adapt or change. What do you guys think about RFQs and or I should say the way to trade fixed income going forward on small lists?
Yeah, I mean, it's changing, right? Even already today, you mentioned putting out a bunch of RFQs and giving people 20 minutes to price them. Even today, that time frame has already shrunk to 5 or 1 minute, right? Because for any RFQ for, call it $1 million or less, it's going to get 15 algo responses within 10 seconds anyway, right? So I think it's already changing. Certainly, you've seen the rise of new protocols, things like portfolio trading that could not exist without automation. Obviously, there's streaming quotes, which have existed for a long time. But to your point, Mark, it was a lot of, I'm going to put out an indicative quote and maybe I'll trade it.
Streaming.
Maybe I'll trade it, maybe I won't. So how valuable really is that?
Right.
And look, our view, I think, is that there's a time and a place for each of these different protocols, but they're all going to get more firm and faster over time, right? Yep. So RFQs have existed forever, and there's a reason. Like, they're a pretty good protocol for certain types of trading.
Yep.
If you are a professional and you know what you want to trade, and you have a pretty good idea what it's probably going to be worth, and you put 20 dealers in comp on an RFQ, you're probably going to get a pretty good price, right? And there's quantitative reasons I could go into actually why RFQs, as opposed to when compared to streaming, there's like different risks that dealers take on, and you can make a quantitative case that on the margin by a little bit, and you could see it in the numbers. RFQs tend to trade somewhat inside of the best bid and offer that you would see streaming, right?
Yep.
And that will probably always be true. But streaming is also a great protocol, and I think it's especially good for people who maybe don't know exactly what bonds they want to trade. They want a menu of options, or who don't know exactly what the bonds should be worth. They're not professionals, right? And you can see and compare all these different quotes, right? I'm basically describing retail. Streaming, I think, is great. It's perfect for retail, right? And so I think you're going to see, you already do see a lot of that. I think you're going to see more of that. OpenYield is obviously an example there.
Yeah, we sure are.
Yep. And then, portfolio trading, we could talk about. It's a newer development. I think there are, again, cases where it makes sense, some cases where it doesn't make sense. I think there was a bit of a, call it a feeding frenzy when it first came out by dealers to basically win market share. And so they traded very, very aggressively for a while, which made them great for the buy side. Whether that's sustainable, we'll see. But there are good reasons for PTs to exist and for them to trade pretty well. And then I think it will be interesting to see over time, do you see new protocols that have never existed or are modifications? So for an example of one that we've talked about in the past, and it'll be interesting to see if it catches on anywhere, is I mentioned that RFQs are kind of natural for dealers and are relatively easy to respond to from a risk management adverse selection standpoint. I think there are ways that you can make streaming almost, RFQs sort of look like streaming. Like, as an example, if somebody pulls up a bond on their app, right? One way to do it is to have dealers constantly streaming prices, and then you could show the price when they pull up the screen. Another way to do it, it's all automated. Computers are really fast. When they pull up the screen, show a little spinny icon for a half a second, send out a really fast RFQ to a bunch of dealers, get those responses back, display that. That looks a lot like streaming, right? But it's technically an RFQ under the hood. Maybe are we going to see some innovations like that over time? I'm sure there's other ones. I would bet yes.
And Mark, sorry to just a couple really quick comments on the back of what Matt said, which I think is interesting. One is, the muni market's fascinating because of the inability to short, you actually have a bifurcated market of RFQs on the bid side and posted liquidity or streaming on the offer side, because you can only really sell what you own in inventory. Yeah. And as a fully electronic firm, and this ties into something Matt said, for retail, how beneficial streaming can be for retail. It's really critical, and it only really works if you're providing firm prices. So if you're doing something in a fully automated fashion, that price has to be immediately executable, both for the dealer, who we don't have the bandwidth on our desk to have people responding to thousands of inbound calls to negotiate on a 5 lot, and similarly for retail, it gives them a lot more confidence in the market if they know they can execute against a very aggressive price. So I think what you've seen, particularly what we've seen over the last few years, is when we first entered the market, it was a lot of like, hey, post the level, I'm having to do it manually. So by definition, I can't have that level be firm. I need to be able to negotiate. So it's indicative, we'll haggle over the price. And so now what you're seeing are firms like us, and we're not alone, there's certainly many others doing this as well, dynamically updating prices throughout the day in response to market activity, because all those levels can be immediately accessed, by the end.
It's something that we're actively working on here. But if needed a level, you should be able to get one supplied when needed, especially in the muni world, where the bid side is a esoteric thing of the past, where it doesn't really need to be necessarily with how it trades. And we can get into that on another podcast at a later date. want to move on to a an interesting topic I find, and that's switching from the secondary market to the primary market. And we've talked a lot about automation. We've talked a lot about retail. We've talked a lot about process improvements. We've talked a lot about products, ETFs, and how to trade RFQ versus streaming versus voice. All of these things have resonated with mass amounts of automation and technology. And then we come to this thing called the primary market, which is stuck, right? The primary market still functions as the large banks issue securities or work with issuers to issue securities into the marketplace, and they are placed into what I would call institutional accounts only for the most part, and then distributed around. And eventually, if a retail customer or somebody wants to purchase it, it can traffic through middleman after middleman, but not at issuance. There's got to be a way for the primary markets to change dramatically if the retail market is starting to rapidly engage in fixed income markets. Do you guys have a purview or a perch on primary markets and what the catalyst is and how they're going to change going forward, or how they could change going forward, I should say?
It's a good question, and it's one that we've.
I mean, I saw you kind of like as I was asking the question, Matt kind of perked up a little bit, so I'm glad that you're taking it.
I was perked up the whole time. So, it's actually, I think we have kind of something of a unique perspective on this, because we came from a prop firm where we had no visibility whatsoever into the primary, couldn't participate at all, right? It was this big mysterious thing. And so we've had to learn a lot since we got here, but also kind of came in with no preconceptions as to what it should look like, right? And I think what we've learned in the, call it 3.5 years since we joined a bank, has been, kind of surprising, right? Like you see all of this change in the secondary, and the primary looks almost exactly like it did 30 years ago, right? It's super old school, very antiquated. The process takes a long time. There's tons of manual coordination among tons of different people. And by the way, it's expensive. Like fees have not budged, right?
That's right.
Where do you see that in the world, right? But fees haven't budged. And look, I think there are cases, there's areas of the world where like that kind of high touch, high fee hand holding like could make sense, right? Like, so take equity capital, IPOs, right? Companies going public for the first time. That instrument truly has never traded before. So you can understand why there might need to be some, finding the point where supply meets demand, matching up buyers and sellers, right? Or let's say a more bespoke, illiquid, dicey credit kind of a story situation, right? Okay, understand that might need some handholding, right? But it's kind of unfathomable to us, like why, I don't know, an on the run Verizon bond, on the run Verizon new issue should require some big complicated song and dance. Everybody knows where that thing's going to price within like 2 basis points.
Right.
Right.
And the issue, normally and regularly, to your point, which gives confidence in how the bonds trade and the liquidity in the system and the tranche size are large enough where, yes.
Sorry. Yeah, exactly.
So I guess what you're saying is there is a large difference in the need for esoteric debt IPOs or cuspy credits that you really need to do some diligence and work on that are, more risky to the ecosystem or more gray versus follow-on offerings from issuers who issue regularly, where the price discovery really is not a thing of difficulty.
Exactly. And then you ask, of course, the follow-up question, why? Why is it the way that it is? And look, I think there's a lot of vested interest involved. There's a lot of sort of institutional inertia, let's call it. We could talk to Lakowski about why it is the way that it is. But again, going back to the phrase I said that we say all the time, and I'm going to say again, we are firm believers that markets do, in fact, tend towards efficiency and transparency over time. The forcing functions for these changes are generally regulations and better technology. in one way or another, I am certain that that same story will play out here over time. Suffice to say, we are certainly very interested and looking for ways to innovate in this space and have lots of potential ideas. I think, by the way, that there is also a big opportunity for a bold, innovative platform to jump in, maybe like an OpenYield eventually, and try to provide value here. But one way or another, I would expect it's not going to happen overnight, but that you will see changes in the primary markets over time.
It's kind of like you circling back to your, earlier comment about, markets and efficiencies and how they kind of find each other, and adding in the retail customer and the access that they should have to all markets. Just like if there is an equity IPO as a retail investor, you have access to it. You can put in an order. Not maybe not on every IPO to your point, but on most IPOs, you can actually put an order in and try to be part of the process now. And hopefully there one day will become a platform or means where uh, investors of different ilks can be a part of the process.
Agreed.
And I have one follow-up question to the primary markets and where we are now. Muni markets versus credit markets in terms of the primary markets and the ease of use and whatnot. Do you see a big difference between the two of them from your seats, or how do you guys view that?
Yeah, it's interesting you say that. The muni market's really it's interesting in so many ways. One of which is the way the primary market works. So there's really kind of two different processes. One looks very similar to what Matt described in corporate bonds. They call that the negotiated new issue market, where there's a primary dealer and a syndicate, and you're kind of using that traditional process to distribute new issue bonds. The other is what they call the competitive new issue market. And really what that is like a big auction, or essentially almost like an RFQ, where an issuer comes out and says, here's some criteria I have for issuing debt. But effectively, any dealer is welcome, any underwriting dealer is welcome to bid on those bonds. And we're going to run this auction process over a period of time. And then, everyone submits their bids, and whoever is the best price ultimately wins that auction. So it's fascinating. It gives the opportunity for issuers for choice of using either one of those channels. And both are quite sizable in terms of their, presence in the market. We have actually in our own business gotten very involved in the competitive new issue space, because again, it to us looks very similar to bidding on a bond through an RFQ process. And so we think we can, or what we're doing is using some of the automation and modeling that we've developed, marrying that with a trader, and then providing that pricing back into the market and hopefully increasing competition on those auctions and creating a better outcome, hopefully for both the issuer and the end investors who are buying those bonds. So it'll be interesting to see. It's an example of an innovation in the muni market that maybe over time ends up filtering into other fixed income products.
You don't find many innovations that happen in the muni market first and go back the other way.
No, you do not. No, you do not. I guess, first of all, I wanted to say thank you guys for taking the time today. It really is, it's been a great conversation. And, I want to end it with one final question before we wrap up. And, from your seats and where you guys started and where you guys are now, and all the things that have happened during your time and the things you look forward to, what is the one thing that you guys are working on together or think about together that kind of keeps you up at night in a good way about the markets going forward?
Marty, you want me to take a stab at it?
You feel free. Yeah.
All right. Yeah, I guess what I would go with is the thing that sticks with me the most is just how much closer to the beginning than the end of this we are. And like we've come a long way, don't get me wrong, credit, for example, at least investment grade credit has come a long way. But there's even within credit, there's so many areas like retail engagement that we just talked about, like primary issuance that we just talked about, that um, again, I think we're closer to the beginning than the end. And then you start thinking expanding the world beyond just credit. Fixed income is much bigger than just investment grade credit in the US. There are tons of fixed income asset classes that have really just sort of barely even gotten started. Munis, uh, we're obviously a big player there. There's some automation there, but if you look at the volume by percentage of volume that is electronified in munis, it's sub 20%.
Yeah.
If you look at things like mortgage specified pools, like loans, there was an article yesterday. I'm sure you guys saw it. I think it was Apollo just
Yep.
launched a marketplace for private credit.
Private credit. That's correct. Yeah.
Right? Yeah. I mean, all of these asset classes are just getting started or have not even really started the process at all of automation and electronification. And as the technology continues to improve, as you keep getting new innovative players, like hopefully the people on this call, but also many others as well, costs and spreads continue
Yeah.
as new innovative players continue to kind of push into the marketplace. I think hopefully the people on this call, but also lots of others as well, as costs and spreads continue to compress, and you get the kind of liquidity begets liquidity dynamic, right? Volumes continue to go up. I think it's going to be a really fun ride over the next 5, 10, 15 years, and we are really excited to be on it with people like yourselves.
Yeah, I fully agree. Do you want to add any final comments about the forward for you guys?
Mark, the only thing I'd add is, having spent a number of years in equities and options and other asset classes, I think, and again, Matt hit on this. We're still in the early innings of what's happening here. I mean, it's very exciting to be part of an asset class where there's so much innovation and change and new ideas that you can execute on, and that's I think that's really unique, and I think it means there's lots of ways to innovate, and we're really excited to play a part in that over the coming years.
I appreciate that, and I appreciate you guys taking the time out of your days. Best of luck to you guys in 2025. I know we'll be in close contact, and also a special thank you to being the first guest of the Markets with Mark podcast, brought to you by OpenYield, the automated bond marketplace. And again, we appreciate it. So this is Mark Hebert and Lewis and Clark of Automated Trading, Marty Mannion and Matt Schrager. Thanks so much, guys.
Thanks,
Thank
Mark.
you,
It was a
Mark.
pleasure.
Take care.